CVP analysis, comprehensive problem. Hello all, time to work a comprehensive problem focused on CVP analysis. As you see, J&J Corporation has provided us with a contribution margin income statement. Note that all data is given in totals. Our first calculations should be to express data on a per unit basis and as ratios. Per unit calculations are done by dividing each line item by units sold. Doing so allows us to know the selling price per unit of $60, the variable expense per unit of $36, and the per unit contribution margin of $24, the difference between the $60 and the $36. We stop our per unit calculations with the contribution margin. We don't apply the per unit calculation to fixed costs because by definition, those costs will always remain the same in total if we are operating within a relevant range. Knowing the contribution margin per unit allows us to easily determine the effect a change in units sold has on net operating income by simply multiplying the contribution margin per unit by the incremental change in sales. Note, at 9,000 units, our profit is $12,000. Increasing sales by 1 unit increases net operating income by the 1 unit times the contribution margin per unit of $24 for a total of $24 change. Increasing sales by 100 units increases net operating income by 100 units times the $24 of contribution margin per unit, or $2,400 in change, to get a new total of $14,400, the $12,000 plus the $2,400. The incremental increase or decrease will always equal the change in units times the contribution margin per unit because fixed costs remain the same if we are operating within a relevant range. Dividing each line item by sales will allow us to convert the dollar amounts into ratio percentages. Dividing the variable expenses by sales gives us the variable expense ratio, which in this case is 60%. Dividing the contribution margin by sales gives us a contribution margin ratio of 40%. The two percentages will always add up to 100%. We can determine both percentages either by using the total amount of sales or the per unit sales. We can multiply the percent by the total amount or per unit amount of sales to determine variable cost or the contribution margin. Required 1 asks us to determine the break-even point. Break-even point calculations can be done in both units and in dollars. Remember, the break-even point is the level of sales at which profit is 0. We break even. At the break-even point, sales dollars or total revenue will always equal total expenses. If we're using the contribution margin format income statement, at the break-even point, our contribution margin will equal our total fixed costs. The break-even point can be solved by equation or by formula. The equation shows that at the break-even point, the selling price per unit times the quantity sold will equal the variable cost per unit times the quantity sold plus the fixed cost. In other words, total revenue is equaling total expenses. An alternative calculation would divide the total fixed cost by the contribution margin ratio. Both calculations give us the same answer. Both calculations will give us the total amount in sales that we need to achieve a break even. Now, if we want to determine the sales units needed to break even, we divide the total fixed cost by the contribution margin per unit. Knowing the units needed to break even allows us another way to determine the break-even sales dollars by simply multiplying the sales price by the break-even units. So at this point, we know how to calculate break-evens both in terms of sales dollars as well as sales units. Once we know the break-even point, we also know that each additional unit sold will increase the company's profit by the amount of the contribution margin per unit times the additional units sold. For our company, J&J, we determined the break-even point in units by dividing the fixed cost of $204,000 by the contribution margin per unit of $24 to get 8,500 units. If we sell 8,500 units, our company will break even. Because we are currently selling 9,000 units, we are exceeding the break-even point by 500 units. When we multiply the 500 units by the contribution margin per unit of $24, we get the $12,000 of earnings shown. Determining the break-even sales dollar amount can be accomplished by multiplying the selling price of $60 times the 8,500 units, or by dividing the fixed cost by the contribution margin ratio. For J&J, we would multiply $60 by 8,500 units to get a total of 510,000, or we could divide $204,000 by the contribution margin ratio of 40%. In either case, the result is $510,000. At a sales level of $510,000, J&J would break even. To summarize, the break-even point is the level of sales at which profit is zero. The break-even point can be determined in terms of units, 8,500, or in terms of dollars, $510,000. If sales were $0, the company's loss would equal the amount of fixed expenses. Anything which increases the contribution margin will result in a decrease in the break-even point. This means your business can break even with less revenue. This is a good thing. As can be seen, we can increase our contribution margin by increasing selling price, increasing sales volume, or decreasing variable costs. If our contribution margin increases and our fixed costs either remain the same or decrease, our break-even point will decrease. A decreasing break-even point means that we will reach a break-even point with less sales revenue or fewer sales units. Now we can take this concept a step further and compute the total number of units that need to be sold in order to achieve a certain level of profitability. This is target profit analysis. The goal here is to determine the units which need to be sold or the dollars of sales to reach a certain target profit. Again, we can solve problems by using an equation or a formula. I'm going to illustrate the calculation using a formula. The calculation requires that we place the sum of the total fixed cost and the target profit in the numerator and divide by the contribution margin per unit to get the sales units needed to reach our profitability goal. To determine the dollar amount of sales needed to reach our target profit, we need to divide the sum of the fixed cost and the target profit by the contribution margin ratio. For J&J, the total profit goal was $50,000. This means that J&J needs to know the units to be sold or the sales dollars to cover both the total fixed cost of $204,000 plus an additional $50,000 in profits. Determining the target profit units requires that we add the fixed cost and target profit to get $254,000. Dividing the $254,000 by the $24 contribution margin per unit gives us 10,583 units, which is the number of units we must sell to reach a profit level of $50,000. Determine the sales dollars needed to reach a $50,000 profit level. We can multiply the 10,583 by the selling price of $60 per unit. Or we could divide the 254,000 by the contribution margin ratio. For J&J, $635,000 in sales are needed to reach the $50,000 target profit goal. Remember, when there is a profit, the contribution margin is greater than the fixed cost. At the break-even point, the contribution margin equals the fixed cost. If there is a loss, the contribution margin is less than the fixed cost. Let's turn to the calculation of the margin of safety. The margin of safety, or MOS, is the excess of budgeted or actual sales dollars over the break-even volume of sales dollars. The MOS is the amount sales can drop before losses are incurred. The MOS can be expressed as a total monetary amount, a percentage of sales, or a number of units. For J&J, the dollar margin of safety is computed by subtracting the break-even sales dollar from the current sales dollars. J&J sales can fall by $30,000 and the company would still break even. By dividing the $30,000 by the current selling price of $60, we know that sales could drop 500 units and the company would still break even. Because business professionals like ratios, we calculate the margin of safety percentage by dividing the margin of safety dollars by the sales dollars. In this case, $30,000 divided by 540,000 to get 5.6%. We now say that current sales would need to drop by more than 5.6% before we would show a net operating loss. Now let's turn to the degree of operating leverage, or DOL. The degree of operating leverage is a measure of how sensitive net operating income is to a given percentage change in dollar sales. If operating income is more sensitive to changes in sales, the business is said to have a high degree of operating leverage, and vice versa. If operating leverage is high, a small increase in sales can produce a much larger percentage increase in net operating income. Companies with a high operating leverage have high fixed costs relative to variable costs. These firms have a large amount of fixed costs. The higher the fixed cost, the higher the operating leverage. High operating leverage means greater risk. High operating leverage also means greater potential for reward. The degree of operating leverage can be computed in a variety of ways. Two of the more popular are to divide the contribution margin by the net operating income, or to take the change in net operating income and divide it by the change in sales. Both equations will yield the same result. Once the degree of operating leverage is determined, it can be multiplied by the expected percent change in sales to determine the expected change in net operating income. For J&J, the degree of operating leverage would be calculated by dividing the contribution margin of $216,000 by the net operating income of $12,000. The degree of operating leverage equals 18. If sales were projected to increase by 15%, then the expected change in net operating income would be determined by multiplying the degree of operating leverage of 18 by 15%. The percent change would be 270%. Multiplying the 270% by the current net operating income of $12,000 would give us a dollar change in NOI of $32,400. Adding the $32,400 to the $12,000 gives us a projected NOI of $44,400. Using bucks is a perfect aid for performing CVP calculations. After all, you must know what calculations need to be performed, so why not box it? You must understand the concepts behind the calculation, so why not underline them? You must make certain that you have organized all relevant data, so why not check them off? You must keep things simple, so why not knock out the irrelevant data? At this point, you have simplified and organized the problem, so why not solve it? Because CVP analysis will play a big part in your professional careers, this is a good topic to master. Thanks for watching the video. Time to apply what you just heard to some problem solving. Good luck.